Bring that ass back like a boom, 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 boom.
Alright, what's up everyone? This is Supernova and you're with Boom Traders Weekly Overview. Let's get it on with the session overview. First things first, we're going to take a look at our risk vest model. And then specifically for trading, the tactical trading environment that is made up entirely of our stock signals. Then we're going to look at the current markets and do a summary. Now the first thing I want to point out is risk vest model, our signal is still negative, and that has been the case since the 22nd of November last year. Now on the 26th of May this year we had a minor buy alert, so to speak. Situation in the markets did change for better, but this was quickly negated this week with the CPI numbers and the reaction prior to that. So if you follow our reviews of the market, you will see that last week pretty much everything here was either neutral or positive. The general market, the up down volume, highs, lows, and stock participation, they all rose pretty well. But as I said, with Thursday afternoon and Friday's action, we definitely have to turn everything back to negative. And when we look at the charts, you will see it was just a horrendous gap down, and pretty much all the indices continued lower throughout the day, finishing in the lower sections of their candles. Consequently, tactical trading environment signal was put on red again. We are primarily breakout traders, so breakouts up until Wednesday they were working. Actually Thursday started okay, but then in the afternoon session pretty much everything broke, and Friday was just to cap it off. So we got our signal back to red, so breakouts are now working well for now. And if you are trading breakouts, you're either better off waiting for better signals to appear or switching to lower time frames just to be able to get in and get out very quickly with what you make. So that was it for the overall view of our signals. Now let's take a look at the current markets, and we're going to start with some charts, and then we're going to take a look at my notes. So first things first, let's take a look at the chart of the S&P 500. So when we take a look at the S&P 500, we have to understand a couple of things. The first thing is that we're definitely in a downtrend, bear market. That's not a surprise to anyone at this moment. The question is how long that's going to take. And the first thing that comes to mind is the Friday's action with this huge gap down, huge volume, and so forth and so forth. It looks like an exhaustion move from the S&P 500. And since I'm doing this on Sunday, I already see the sharp sell-off in crypto again. It does look like exhaustion, mainly because of the gap, mainly because of the volume on this fluid down bar. You can see right here on Thursday, actually up until the second half of the day, stocks were pretty much hanging in there. We're not doing that bad, but come the afternoon session and everything just fell apart. So if we're looking for some supportive action on the S&P 500, the most logical and technically sound places to find one will be, well, first we have to look at this area right here. Let me just remove the snap. The first area right here, obviously these lows right here on elevated volume, that will be the first zone. If that fails, I'm looking for the trend line support formed by these lows right here. They were tested twice here, failed, and moved higher. So this would come to something around 375, and then next logical area is the 375 zone formed by these attempts right here. Basically, if you can see right here, we had a gap up, and then this gap was closed and was tested a couple of times right here, once, twice, 3 times, 4 times. Then we just move higher, and an even lower zone at about 358 I can see right here from this prior all-time high that was gapped up with this huge rejection candle right here. We closed below it, then we gapped up again, closed below it, gapped up, and then tested it a couple of times right here. So these are the obvious zones for S&P 500. I don't see how we're going to go higher from here unless we do some very constructive consolidation right here somewhere at the lows. Otherwise, this is just going straight down. Now, as for QQQ, picture basically looks exactly the same. I did not draw any support zones right here. I just wanted to do it with you. So the first thing I'm going to do is just draw those lines to the downside. You can probably extend this right here as well. It's pretty much the same thing. Obvious zone right here is about 270 for the Nasdaq. It's almost coincident with this right here. This is about, get my snap to work. We're having a low right here of 266 and 267. So about 267 for those, and we have around 268 for those. So this is the first zone that I'm seeing as support. Next one comes at 259. This is 260, right? So these zones right here are vital for Nasdaq to hold. Now, if I draw that, you can see also right here we have this formation. It was trying to break out, and there was like a gap right on top of these lines. So it's definitely an area where we can find some support. If we fail this, as I said, 260 next obvious level, then we have to dig deeper and probably go to about 240. I'm sorry, right here. But anyway, Friday's action, if we have to speak just about Friday's action is pretty much as horrendous as on S&P 500, although volume was a little bit lower than on the S&P 500, but again, same gap down, although some names did try to pop up. Now let's look at IWM, small caps, definitely looking much better than S&P 500 and Nasdaq. Now, the first thing that I can definitely see right here is support, and that's pretty much lower, but I want to talk about it. Take a look at this high right here and the gap that almost gapped this and shoot up from there. Now, we tested it once right here, and now it looks like we are aiming for the same spot, which is around 170. So expect some support right there. Last but not least, Dow Jones, same thing, same story. Nothing really has changed here as well. We can also draw some trend lines, but I think that the most logical place to actually be thinking about support right here is around the 300 zone, which also coincides with this candle right here. So around 300, which is pretty much century mark. You can also see that the highest point right here before the COVID drop was at 295, 296. So this is pretty much like a zone of support right here around 300 to 295. If we look at the advanced decline and some of the market internals, I have my S&P 500 here at the bottom and QQQ is at the top. You can see the advanced decline line, the blue line is the advanced decline line. It's just going sideways, but it's still not making lower lows. So this is the lowest point of the advanced decline line as well for the S&P 500 right here on this drop. So we're still not undercutting it, and I mean stocks are not particularly not behaving particularly bad for now. As far as new highs, new lows, you can see definitely we have a red bar here. So new lows are quite more than the new highs on the S&P 500 and Nasdaq. I don't think it's a surprise for you right now. The advanced decline line is shooting straight down. Basically, you can probably draw here trend line. I don't know, I haven't drawn it, but it might, yeah. You can just draw a trend line on the advanced decline line, and you can see that the action is just straight down, straight down, straight down. It's pretty much like a channel. Net new highs, net new lows. I don't think that there is pretty much anything to discuss here. It's all red, so new lows are more than new highs. IWM, same thing. advanced decline line is trying to come to the lowest point right here, so looking weaker in terms of the advanced decline line. And the only one that actually stands out is the Dow Jones Industrial. You can see the advanced decline line is actually in a slight uptrend, regardless of what price is showing. So I'm thinking pretty much that the overall market is weighing in on the Dow Jones Industrial when we're talking about charts. Let's take a look at the market internals quickly. I just want to take a look at the overall chart of the 52-week highs and 52-week lows. We almost came closer to filling that gap right here and basically crossing into positive territory, but that failed, and now it seems like the 52-week lows are starting to elevate again, with the 52-week highs are dropping even further. And I don't really know what is the lowest point of the 52-week highs recorded, but even during COVID, let me see if I can see right here. High 23.8, 7. Yeah, we had like 7 in terms of new highs, and right now we are at 35. So yeah, there's still some time to go, dropping further. But obviously, more stocks are making 52-week lows than they are making 52-week highs. So I just take a look at my reversal indicator, and it's not suggesting that we are in for a reversal. Now, basically, this indicator is we have here a stochastic slow indicator that is bound to the moving averages. So this is the S&P 500, and I just use it for reference at the bottom. The important part is the middle section, which is stochastics, as I said, stochastic slow, basic formation, basic parameters on the stochastics. Yeah, I can actually open it up so you can see pretty much 14, 3, 3. Everything is smoothing type is 1, so we have oversold and overbought at 20 and 80, just regular stochastic slow indicator. And right here we have the percentage of stocks above their moving averages. So we have the green line is the 20-day moving average. So right now we have the green line at 31.82. That means that 31.82% of the stocks in general on the entire United States market are above their 20-day moving average. Now you can see clearly right here that when this green line gets below 20 and stochastics is oversold right here, we do make a bounce in the market. That was pretty much the case a couple of years back. I can zoom it out quite a lot, but pretty much every time we have a bounce in the market, like take a look at right here, this is this is in January, so this is quite oversold. It's below 20% of stocks above their 20-day moving average. Stochastic slow is oversold, and we have the market bouncing. Here stochastic slows oversold. We come very close to 20 on the green line. Same thing here. Stochastics in the middle, so we cannot count this as a valid signal or whatsoever. We had a couple of here. We made a couple of moves up on the S&P 500. Here's the same thing. You can see right here. You can see it right here. You can see it right here. Although this one did not get. That's why I have the 30 as well. 30 is danger zone, but the 20 is really oversold. But since the stochastics is still in the middle zone, I'm not even considering this as a bounce. Let's see what happens next week. In terms of the VIX, well, VIX has been riding on the lower band of the Bollinger Band, so it was due for some bounce. And the good thing is that the S&P 500 is also approaching the lower band of the VIX, maybe 5 points more, which coincides with some of our support that we draw. Let's see. 385. Do we have 385? No, we still don't have. Well, 385 is right here on the lows. So VIX is supporting the idea that this might hold a little bit. You know that I like S&P and Nasdaq with the VIX signal and the Bollinger Bands. So pretty much that's what. Oh, okay. Let's take a look at the put call ratio. I want to see if it's rising. Yep, put call ratio is rising. Did we have above 1? Yeah, on Friday we had 1.18. So this is pretty high as a reading, meaning that People are panicking and are starting to buy in some hedge. So yeah, it's so. I wouldn't call that as a bottom because this week is pretty important. It's still up to see what the Feds are going to do. There's some news that we might actually see a 0.75 rate hike based on the CPI numbers, but we're going to talk about that in just a sec when we get to my notes. So this is for the market and the market internals. As I said, we're still looking for lower prices for next week. So to start off my notes for the week, clearly the most important event was on Friday with the CPI announcement, and right now inflation is running at 8.6% year over year. You know that the Fed targets around 2%. And here on the right side, you can see the graph of how inflation has been peaking throughout 2022. And on the left, the small graph is basically monthly inflation. The one that we recorded right here in May, so far that 1% is the highest, the second highest in terms of monthly inflation for the last 10 years. The only one that's superior than that is, you can see right here at the spike, is April's inflation. So basically inflation is raging, and this is what got into the market on Friday because having that CPI being higher than previously thought, basically it's setting up the Feds for on the hike that is even more than the anticipated 50 points. In fact, JP Morgan, I believe, was the first one to go for a 75 point hike. That was on Friday after the CPI numbers came out. So it's up to see what the Feds are cooking for us this week. However, please keep in mind that we had this May month, and you can see in the left chart at the bottom, you can see this the month that's after April. It's like a very small bar. That was really surprising for everybody, and that's why the market started rallying. So now with inflation back soaring, we're pretty much reversing it. That caused the harsh reversal on Friday with the gap downs. So that's the first thing that I have in my notes. It's very important CPI numbers because, as I said, the Feds are targeting around 2%. So they will be hiking the rates up until they get into that 2% target. The second one is the 10-2 yield Treasury yields curve, and it's starting to invert. It inverted once earlier this year, then just bounced back. Now, this is for the last approximately 10 years, and I just want to mention this. The only time when it actually inverted was right here, late 2019, and the markets did not actually correct. That's around August right here. The markets did not correct until March of next year due to COVID. So it wasn't like the yield inversion actually caused COVID, right? I mean, it doesn't make any sense. They're not connected. So this indicator, although it's mentioned quite a lot in the public and it's thrown out there in the media to basically scare people out, does not really have a very good predictive value. I just put it here because people are talking about it. But as you can see from the chart clearly, and that's the S&P or SPX, whatever, at the bottom, as you can see clearly, there's zero correlation, at least zero correlation to me for the last 10 years. So I don't really think this is much of a it has much of a predictive value. Now this is one from Ned Davis Research, the prime market research company out there, and I just want to show you right here where we are with this black arrow in terms of length of the bear market. We're right about 100 days, and in terms of percentage correction here on the vertical, it's the percentage correction. So we are moving further to the right in terms of length. We're still staying pretty shallow compared to other bear markets. So we're close to the 20%. That's on Dow Jones Industrial, close to the 20% correction. And in terms of time, we are around 100 days. There's still there's still some more time to come in order to get into the average for what it's with recession and without recession. And you can see right here in the legend, cyclical bear markets independent of recessions. Mean for cyclical bear independent of recessions is 25% loss and 213 days. And so right now we are at 100 days and less than 20%. So still some time to go. Cyclical bear coinciding with recession. So if we get into the recession territory, then we have a mean for that at minus 34.6 loss in 353 days. So still at least 100 days out for this bear market until we get to the mean. And that's if we don't have a recession. And if we have a recession, at least 250 days more to the mean. Of course, there are extremes, but let's take a look at the mean. This is another one which is WLI growth. It's comparing the gross domestic product, GDP, and recessions. And there's really no point explaining what the exact index is it's calculated and how it's comparing things. But what is really important is to see the levels that it usually are supported for the index. And right here around -5 to -10, you can see most of the time this index will just bounce back with the market, of course. For a few exceptions are, here like recessions in 2008 and of course the COVID pandemic. But ever since 1980, we haven't had like a reading lower than -10. Right now we're around -5. Last but not least, I want to talk about sentiment a little bit more. Here we had a bounce in the sentiment, so bullish sentiments was back on high with our bear market rally. We played a lot of tickers with this rally as well. We're able to bank some profits on a few of them, stopped out on another few of them, and pretty much nothing is working. Nothing was working on Friday, but this is what bear market rallies are. So sentiment is showing that although we had like a bounce in sentiment, now it's coming back. And I think that if we undercut the lows, we're going to see extreme bearishness settling in, which if we see a little higher or elevated put-call volume ratio, well, put volume in this case, put volume is above 1, and if we can get to 1.1, then we might see this capitulation with some volume thirst to the downside, and then just put the lowest or the bottom to start forming a nice bottom out of it. But this is just an opinion. We might see prolonged bear market. You never know how it's going to go out. As far as CNN's fear and index greed, we are still fear and greed index. I'm sorry, we're still on fear, not into the extreme fear territory. And if you compare it for the timeline and how it has been doing since the beginning of the year, you can see that we are not at the lowest. We're actually around the mean of the index so far. So nowhere near the levels. This is, I think it was around it was around 7, which is really extreme fear. It was around 7 right here, early May. So Bitcoin, that there was another sell-off in coins and in crypto in general this weekend. We saw more than 10% drop in Ethereum, 5%, 6% drop in Bitcoin. Obviously, extreme fear is the prevalent mood. But, in a sense, this is good, because once extreme fear sets in, once capitulation sets in, that's the time when we start looking for opportunities. And if we get some positive follow through in the market, then we're clear to start loading up on the best performing stocks. So let's take a look at the top and bottom industry groups, what's shifting, what's moving higher. And before I even open Market Smith, I can tell you that we saw on Friday some retail and food stocks actually making highs, which was interesting, but also playable. We in the group, one of our moderators in the group played a nice trade for 2R win during the day. That was good. So now we're going to open the Market Smith and see what the groups are showing us. So, as usual, we have the markets mid grow 250 target list containing 300 names. I always wonder about that. And we have the additions for this week list sorted by industry. So, just by looking at this very quickly, we can gauge and have an understanding of what's strong and what is not, and what's being dropped and what is starting to emerge. Just gonna scroll down through them and see if some industry or category is popping up. Of course, oil and gas exploration. I don't even think that I need to go through them. These are by far the leading industries right now. So pretty much every scan for consolidations or every scan for entries around the highs will definitely include names in the oil and gas industries. What I noticed here earlier when I did it by myself is that we have some medical and biotech popping up. So that's the first category with 5 names. As I said, on Thursday and Friday we saw food and retail moving up. So we have 4 companies in food and packaged. We have finance and property as well. With 4 names, and the other one is computer software and enterprise. Well, that is a surprise. Yeah, I've actually noticed CDK moving, but I didn't know that there were so many. So that's interesting. We also have like energy, solar, and energy alternative right here, but of course that's still in the energy sector. Apart from it, so let's disregard XLE and talk about computer software enterprise. This is one that we have 5 actually. This is computer software specific enterprise, but it's pretty much the same category. We have food and package 4, finance and property right with 4, and medical and biotech with 5. As far as deletions go, let's do the exact same thing. Yeah, I noticed something. I'll just show you in a second. That was a huge sell-off right there. So utility electric power with 6, utility diversified, and this transportation and shipping, we had major sell-off in those companies. So you can see right here, these were some of the leading companies that we see: Eagle, Bulk Shipping, G&K, GoGo, Green, SBLK, Zim. These are all companies within the transportation and ship. They all sold off pretty hard this week. So this is one of the groups that has been deleted from the growth 250. Another one, transportation and logistics. Well, that's pretty much carrying from the transportation and ship category. And we also have finance property right. So basically just some stock rotation right here. And what else do we have? Well, no, it's just single companies around. So basically that's what's setting in for the deletions: utility diversified, transportation, ship, and utility and electric power. Now let's switch back to the presentation and do the summary, which will include, of course, the risk vest. As we said, that's on negative setups. Well, you usually have to be very selective, but now you have to exercise extreme caution or just stay in cash. The market is definitely in a correction. Put volume is elevated, although as I mentioned, we had it on 1.15 on Friday, but I really need to see the moving average of the put volume elevating as well, moving up. So we need a couple of days to move that up to about 1. It's still below 1. So this is getting into the right direction for a market bottom, but we still need it a little bit more elevated. Volatility is still neutral. And that neutral is compared to recent activity. If we had a very calm bullish market, of course volatility will be on extreme elevated status right now, but given the conditions we've been in since November last year, I'll say volatility right now is neutral. And of course there's still the macro factors working their way out. We have inflation, we have the rates, which are basically playing off of each other, and then of course we have the war, which causes this crisis with energy sources. So basically they're all interconnected, but these issues are still in play. So until further notice, please stay in cash or be very selective with your setups. If you like what you see, go ahead, join us in Discord, follow us here on YouTube, like, subscribe, And until next week, I'll see you. Take care, guys, and happy trading.